the withdrawal of the FPO, extraordinary circumstances and situations in the Indian market, and also for a large, fast-growing group like the Adani group. Your first thoughts really, Nilesh, before all of us jump in?
From the investor point of view of the FPO, it's a very good move. They were staring at a mark-to-market losses immediately on investment. With the cancellation of FPO, that loss is avoided. So certainly beneficial for FPO investors. From the existing investors stroke lenders point of view, they have to reassess whether withdrawal of FPO will have any impact on the balance sheets or the growth plan. So essentially, depending upon where you are, you will have to evaluate your position.
Would it be a fair question to ask Nilesh Shah at this stage that post the Adani incident, wherever there is large external debt of Indian companies, the risk premium will shoot up sharply? I am taking this point beyond the immediate group, and whether there are broader concerns that you feel are likely to emerge.
So again, I don't think so that is likely to happen. For decades, India has received a far tighter spread compared to what its credit rating suggested. Number two, while Adani bonds are getting impacted, other Indian bonds are still trading at where they were trading before. Number three, as US interest rates have gone up and forwards have come down, the cost of borrowing in rupee market is now cheaper than cost of borrowing in global market on a fully hedged basis. There are few institutions like Exim Bank which has borrowed money in global market in recent times, but by and large companies are finding that rupee market is cheaper service global market. And to the Udayan point, when Satyam Saga opened, I was working in ICICI Prudential Mutual Fund, and you can check our portfolios. We had zero holding in Satyam Computer Services Limited. We had asked this question to Satyam management then, you show so much cash on the balance sheet, but where is the return? So it's not that mutual fund guys don't do the research. They do research. Sometimes we are right, sometimes we are wrong.
This was not intended for Nilesh at all. My point was a broader point, that all this great research which happens in the on Dalal Street sometimes actually misses the point completely. They are research analysts sitting in their own cubby holes in Lower Parel, and they're doing numbers. It's all Excel sheet management.
Okay, quick point before we head across for a break. Do debt investors do much better research? I believe to some extent that happens.
It may, but you look at the behavior of global rating agencies and how many times they have got caught out in the last 20 years. I mean, they are supposed to be the gold standard of this kind of debt-oriented research. And look at how S&P and Moody's have faltered over the last. People have lost all respect for rating agencies at a corporate level. So, I mean, what does all this research mean? I am not saying Adani Group's assets mean nothing. All that I am saying is that once things start unraveling, they have a habit of unraveling very quickly beyond what you think is possible, and therefore it's prudent to be cautious about how much can be liquidated and what is actually owned by a corporate entity before jumping to conclusions.